this is a very long game. And if you get your first funds right, you get to be in venture for a really long time. And if you don't, you won't be able to keep raising capital. And so all the pressure's on in those first few funds. The fund size is typically smaller. The investments, the sourcing, the picking, the winning, the adding value is typically done by the core people who thought they were uniquely positioned to start this venture firm. Over time, teams grow, fund sizes grow, strategies may evolve. And some of those can be positive, but often those are not positive.
This Week in Startups is brought to you by LinkedIn Ads. To redeem a $100 LinkedIn ad credit and launch your first campaign, go to linkedin.com/angelpod. Ketone-IQ is a clean energy boost without sugar or caffeine. Get 30% off your first subscription order of Ketone-IQ at hvmn.com/twist. And Uizard. Struggling to transform innovative ideas into concrete product designs? Uizard can help you turn your visions into polished UI designs in a fraction of the time while enhancing collaboration across your entire team. Get 25% off Uizard Pro for an entire year at uizard.io/twist. That's uizard.io/twist.
Hey, everybody. Welcome back to This Week in Startups. I'm Jason Calacanis. I run a venture firm in Silicon Valley called Launch. And we have a couple of programs like Founder University, and we do this podcast, This Week in Startups. You may have heard the other podcast that's gotten a bit popular, All In. And what I do for a living is I record a podcast every day, and I invest in 100 companies a year. So right now, I'm doing a series here on This Week in Startups called Angel. In this series, we're having LPs, limited partners. Who are limited partners? Limited partners are the investors who put money into venture capital firms. Those limited partners can include family offices. You may have heard that term. A fund of funds where they invest in many venture capital firms in one vehicle. It could be a retirement fund. You may have heard of CalPERS or firefighters, et cetera, having their retirement funds have exposure to venture capital. These LPs could also be endowments. Harvard's endowment, Yale's endowments. It could also be sovereign wealth funds. You may have heard of folks from the Gulf or from Japan or China, Singapore, wanting to put money into venture capital. They're all limited partners. What limited partners do is they back venture capitalists who are also known as GPs. So LPs and GPs are the terms of art. LPs, they manage pools of money. They want to get exposure to equities like public companies, real estate, private equity, and most of them now are enamored or very interested in, somewhere between those two, venture capital. Venture capital in a lot of these portfolios are 5 to upwards of 25% of their diversification. So we thought we'd do a series to try to get inside the mind of LPs. Why is this important? Well, many of you are looking to become LPs in venture funds. So it's great to hear what professionals who do it for a living think about it. And then some of you who listen to this pod are, of course, GPs running your own venture firms or thinking about starting your own venture firm. Obviously, LPs are going to be your partners in doing so. And then finally, startups. You're going to really care about what LPs have to say because you'll understand how the entire ecosystem works. And if you understand how LPs manage their GPs, these venture capitalists, you'll understand how you need to manage your relationship with venture capitalists because it's all part of this wonderful ecosystem in the United States, primarily, that drives massive innovation. And it's one of the reasons why, if you look at the 25 publicly traded companies, the largest ones in the world, it might be 19 or 20 of them are from the United States. We have really perfected this ecosystem. Today, we've got Alex Edelson. He runs a fund of funds called Slipstream Investors, and he is going to give us a deep dive into why he chose to be a fund of fund managers and what he looks for in venture capitalists and GPs to back. Alex, welcome to the program.
Thanks, Jason. Thanks for having me on.
So let's talk about it. What is a fund of funds and why have you chosen this as your profession?
Yeah, so a fund of funds is essentially a portfolio. Ours is a portfolio of early stage venture funds. We invest in pre-seed and seed funds. Most are 100 million and smaller. We're relatively concentrated, so most of the capital goes into 9 to 12 core funds. Our LPs then get diversified exposure to early stage venture funds. So it's diversified over time, geography, sectors, companies, and And, the ceiling is a little lower than investing directly into a venture fund in terms of the ceiling for potential returns. And the floor for potential returns is a little higher than the floor for investing directly into a venture fund. And so, yeah, I got into this because I was at QED and sort of looking around. I started as the chief of staff for Nigel Morris there, and I became the COO and general counsel. And I was looking around and thinking like, man, there are some great investors here, and they are very compelling founders, can add value in a lot of ways. I'm not sure like why a founder would pick me over anyone on the investment team here. But what I was learning was like how to run a venture firm and what a good early stage venture firm looks like. And we spent a lot of time internally talking about that and just being exposed to it, just sort of living it over a period of years was really helpful. And then we got a lot of founder feedback. So we'd get founder feedback every few years. We had a lot of founders when I was there, and hearing from them, like, what's a great early stage venture firm? How can we be better? It was pretty rich feedback we were getting. So I was getting this unique view into like, what's a great early stage venture firm? And then what I was seeing when I was there was like, we're working with these emerging managers in a variety of ways. We're sourcing deals from them. We're bringing them into deals. We're partnering with them on events and just all these other ways. Well, what happens? I'm seeing great funds who we all agreed were like very high quality funds, and our beliefs about their quality did not necessarily correspond to their ability to fundraise. So we may think they're great. That doesn't mean they're great at fundraising. And so there was just like a ton of opportunity to invest in these funds and to co-invest in their breakout companies because they're small funds. They're not going to continue investing forever. And as I built relationships with them, what became interesting to me was like, they viewed me as helpful. They viewed me as someone who was helping build and run QED and maybe could help them build and run their venture firms and to help professionalize their firms.
So why do LPs then use a fund of funds? Because they pay for this privilege. They pay, I think, 1 in 10%. So they pay a 1% management fee. It means if you had a $100 million fund, you'd have $1 million in an advance against the returns on. You get 10% carry. So if the 100 million turns into 400 million, the team would get 10% of the $300 million gain, $30 million over 10 years. Pretty good living if you can get to it. Could result in, if there were a couple of partners making $1 million a year each. And so why do they choose to pay those fees as opposed to just picking funds directly? I mean, I know the answer, but I'm asking you to give me your perspective and what you hear from those LPs that then give you money to put into venture firms.
Yeah, it's a great question. So, there are different types of folks looking to get exposure to venture. And I think the answer is different for all of them. So like a big part of our LP base is folks who don't have any exposure to venture. They're not going to spend the time trying to get it. Like they may have another career like that they're focused on, like they're a doctor or a lawyer or in real estate or something else. And they would love exposure to venture, but they don't know how to find or evaluate venture funds. And they may have heard of top tier brands, but those are hard to get into and the minimum check sizes are very large. And so for them, a fund of funds makes a lot of sense. Now, there are others who know, I'll speak to Slipstream in particular. There are others who know that the small emerging managers are a big part of the best performing funds in any given vintage.
Why? Why are those early stage funds, overperform? I mean, we the statistics show this. The seed, pre-seed funds tend to do better on a multiple of cash, but they're smaller. So what do you think is the reason for that?
Yeah, it's a great question. And let's be clear. These are some of the best funds. They're also some of the worst funds. So like, I don't want to oversell this. Like, it's hard to do well in venture by picking the right venture funds, especially by picking the right emerging managers. But if you pick the right ones, they are usually in the highest, and they're among the best performing funds in the asset class. Why do I think that is? I think there are a few reasons. Some of them are like, qualitative, subjective. Some of them are like based on portfolio construction and fund size. So like, let's start with the latter first. High ownership relative to small fund size. I mean, ownership relative to fund size is a general matter. I think is a great predictor of the return potential of a fund. So if you're getting high ownership relative to your fund size.
And high ownership, you would say, is what in a startup? You get to 10% ownership, 8% ownership, 15% ownership. What would be high?
Yeah, so it's relative in my view. So like if you're a $10 million fund getting 3% ownership, That's incredible. That's like $100 million fund getting 30% ownership, which you typically don't see in the US unless there's like serious risk of adverse selection. I think about it in terms of fund size. So if you're a $50 million fund getting like 7 to 10% ownership, I think that's great. If you're a $30 million fund getting, 5 to 7% ownership, I think that's great. If you're a $5 million fund getting 1 or 2% of ownership, I think that's great. And even lower is totally fine and can generate excellent returns. A $10 million fund getting 1% can do really well.
Don't I know it?
Yeah. So the math answer, the portfolio construction answer is that if you get a winner when you have high ownership relative to your fund size, the returns can be unbelievable, like well into the double digits, right? And we all know some anecdotes there, and we've all seen some, and maybe been fortunate to be LPs in them or worked at funds like that. But there's also a qualitative factor to this. So like you're in your first 3 funds, like you're betting your career on this.
Yes.
You're all in. Often some of these folks have made it. So maybe you would argue they haven't bet their entire career. Maybe they're a successful operator with an exit. And if this doesn't work out as a venture capitalist, like they'll be okay. But as a general matter, like this is a very long game. And if you get your first funds right, you get to be in venture for a really long time. And if you don't, you won't be able to keep raising capital. And so all the pressure's on in those first few funds. The fund size is typically smaller. The investments, the sourcing, the picking, the winning, the adding value is typically done by the core people who thought they were uniquely positioned to start this venture firm. Over time, teams grow, fund sizes grow, strategies may evolve. And some of those can be positive, but often those are not positive for fund level returns.
All right, listen, B2B marketing is hard. We all know that. Why is it hard? Because buying cycles can be long and B2B decision makers are hard to find and they're really hard to target. So here's the best solution for B2B marketers. LinkedIn ads. Everybody knows LinkedIn because it has over 1 billion members. We're all there every day, hanging out, looking for new executives, sharing our wins, and just generally staying informed. But did you know out of those billion users, 18%, 180 million are senior level executives, and there are 10 million C-level executives. Those are the CEOs, CTOs, CFOs, COOs, chief strategy officers. You know these folks. If you want to close big deals, you got to get in front of decision makers, and these are the decision makers you need to target. And according to LinkedIn's data, when B2B tech companies use LinkedIn ads, they generate 2 to 5 times higher return on ad spend than other social media platforms. LinkedIn ads is a no-brainer for B2B companies. You'll build relationships with these decision makers, you'll drive results for your business, and you'll do all of this on a platform that respects the world you operate in. So here's a call to action. Make B2B marketing everything it can be and get $100 credit on your next campaign. Go to linkedin.com/angelpod to claim your credit. That's linkedin.com/angelpod for a $100 credit. Terms and conditions do apply. On a qualitative basis, you've got people who are hungry, putting their reputations on the line. They have pride. They're proven winners. So when you pick an emerging fund manager, those exist in the world. Who are emerging means they're on their first 3 funds or so. After their 4th or 5th fund, maybe they're more established. And most funds never get to their 3rd or 4th fund. Yeah.
Yeah, that's right. And it's interesting, right? I mean, there's obviously a survivorship question there due to performance on both directions. So like, let's say a fund doesn't do well. It's not looking promising, harder to raise capital. Let's say a fund does really well. Those people might say, hey, I don't know that I need to keep doing this. Venture's hard. Like we've done well for ourselves.
This is too much work. I'll retire.
Yeah. Or we see people saying like, let's just use our own money. We don't need outside
that happened with Homebrew, right? Homebrew was like, we're going to just use our own money and we'll be super selective. We've made some money. We'll take 100% carry because it's our money. And so your point here is those people are hungry. As time goes on, maybe they're less hungry. So that's one of the qualitative reasons why seed might overperform. But it is a lot of work. And so that has been my experience. And so, and the anecdote you're referring to, a lot of the people who are the Uber first investors, when I was a scout, that fund, I put $650 to work. And I think the DPI was 120 million or something, depending on when you sell your Uber shares. And Chris Sacca was in that as well, the first round of Uber, and his fund was famous for being, also a 100x fund or something crazy like that, right? 200x fund. Yeah. And I think Ron Conway had I think, a little tiny piece of Google in that one of his first 10 or $20 million funds. And that one did extraordinarily well too. And I was in one of the funds that was in WhatsApp, and that was a 20x fund. So it's very rare to get 20 times your money back, cash on cash, after 10 years. The averages, I mean, maybe you could explain to people what the averages are for seed funds, cash on cash versus, say, the stock market or IRR or both, however you want to sort of phrase it.
Yeah. Well, one thing you said, though, reminds me of a point that I should have made before, which is talking about the emphasis on small funds. And I didn't completely answer your question about why folks invest in fund of funds. So I can circle back to that too.
Yeah.
But one thing that's really compelling about the emerging managers and the small funds, you're naming iconic winners, companies that have reached valuations that are astounding, that no one you probably assumed was possible
once in a career
at the time. Yeah. And so like you can get low ownership in those relative to your fund size and still have a great fund. I mean, those exits are so unbelievable.
Yeah.
But one reason why small funds and high ownership relative to fund size is really compelling is that if you get more modest outcomes, which is much more likely than getting the next Google, you can still generate great fund level returns if you have high ownership relative to your fund size. And we can sort of go through an exercise. It's like, hey, you had 10% ownership, not diluted much. You're a $50 million fund. Like, what's a fund returning outcome, right? And it's much more modest than like some of the outcomes you're talking about.
10% of a $5 billion company. If a company became worth $5 billion and you owned 10% of it, that'd be a $500 million return on a $50 million fund. You'd be a 10xer. And you just have to go, look, how many times does a company become worth $5 billion and you can maintain your ownership? Or even if it was half that, $250 million on a $50 million fund would be a 5x. So the math kind of pencils out. Yeah.
And so what I think about when I'm investing is not like what's going to happen to this fund if they get a $5 billion exit. Because if they get a $5 billion exit, they're good.
Yeah.
How good? Well, sure. That's what the math is for. But like, I want much more modest outcomes to generate meaningful fund level returns.
Yeah.
And so, if we're getting like $250 to $500 million outcomes, which are much more likely than a $5 billion outcome, I want that to be meaningful to the fund. That actually raises, in my view, the floor on the fund level, on the likely fund level performance. And so there's a lot of, it's risky in many ways to invest in small funds with limited track records. On the other hand, the math is like very much in your favor if you happen to be right. And so, and circling back to the question about why folks invest in fund of funds, the one answer is certainly true for Slipstream in particular, where it's folks who just don't have exposure to the venture asset class and they feel like this is a great way to get it. They wouldn't get it if it weren't through a vehicle like a fund of funds. But the second answer is folks who know these are the best performing funds. They may know these are also not the best. These are also some of the worst performing funds. But there's so many. They are very hard for some folks to evaluate. And for some of them, it may be difficult for them to get an allocation. Like some of these are oversubscribed. Some of them are oversubscribed quickly. It's a lot of work. Hard to get into,
just like it's a lot of work as a seed fund manager to manage 50, 100, 200, 300. I have 400 portfolio companies now. Now some of the in total just over a decade. Now some of those are gone right now, or Uber's Uber, and I maintain a relationship with Dara, but I'm not involved like I was as a seed investor, obviously. But your job is very hard. You're going to put 9 to 12 fund managers into your fund of funds. I understand your fund of funds is 50, 100 million, 200 million ballpark.
Well, yeah, I'd rather not talk about my fund size on here, but my current fund size is like a little under 15. So it's a pretty small fund. And I want to stay very small. Like my next fund's not going to be that much bigger because for a variety of reasons. But you might be 10% of a fund that you're going into, 5 or 10% of a $10 million or $20 million fund. Yeah, it's funny. I actually don't worry about the percentage of a fund that I am. I think for funds where I'm a small percentage, I actually find that I'm as closer to the GPs, just because I think I'm working with them in ways that other LPs aren't because of my experience at QED. And I think I probably behave a little more like a GP, and then I'm very open and I'm constructively challenging folks and I'm responding to everything they send out. And so I end up being close, I think as close as maybe a much larger investor. And I also have, no concerns about being a very large investor. Like if there were someone who I was really high conviction on, I'd be their only LP. I don't really worry about the percentage of a fund that I take.
And by the nature of investing in a dozen venture firms, you hope you're going to hit some sort of an average, because like a mutual fund, you want to pick the best vehicles, but you could have some underperformers, you could have some overperformers. So therefore, you're giving your LPs who are in your fund of funds, a bit of an average, hopefully a higher end average. So maybe you could explain your strategy there and what their expectations are. Or is their expectation, hey, if you just hit the average is pretty darn good for seed in our industry?
Yeah. Here's how I think about it. When I'm investing in a seed fund, I want to see a path that seems plausible to like a 4 to 6x net of their fees. That is very high performance based on historical benchmarks, but and they won't all get there, and hopefully some will outperform it. That is where I hope they get. For pre-seed funds, I'm hoping that it's more like I want to understand and believe in a plausible path to a 7 to 10x net fund. Is it a failure if it's not a 4x seed fund or a 7x pre-seed fund? No, it is not, because at bottom, my thinking on, what's success in ventures, like if you're over a 3x net, I don't think anyone should be complaining about that performance.
No, I mean, if you were to,
I think that's really good by historical benchmark.
They say it takes, 10 years to double your money in the public markets historically. So if you are 3x in the same period of time, you beat the market, which has liquidity, of course, by 50%. If you hit 4x, you're probably doubling it. And so just back of the envelope, people who are allocating capital, and I do myself, I'm in 24 venture firms, my 4 and 20 other ones. I look at it like, I got money in the stock market too. If this beats my stock portfolio and the money's locked up for 10 years, 12 years, I'm kind of like that as a feature. I know it sounds crazy, but it's kind of nice to put, I'll typically put 25K to 250K as an LP, individual LP in these emerging fund managers. And the highest I think I've gone is 500K with more established folks. So it's probably on average 100K in each of these. So I have a couple of million in venture just as a small, investment for myself, but also it helps me build my network and it helps me support other managers. And, I'm looking for a return. But if I triple, quadruple on average, great. Once in a while, you'll hit a 20Xer. Man, that lifts everybody's average because I'm in 20 funds. Now, every fund has got one more turn, right? One more X on top of it. So if my average was 3X across 9 funds and somebody hits 20, well, there you go. Now everybody's a 4X fund. So the math does pencil out for me with my access, I think, to funds.
Yeah. And I think that's right. And so some people would say, hey, why not invest in like 30 funds, right? Why not invest in 50 funds? More likelihood of hitting some of the sort of generational companies of any given vintage. Why not just be lower concentration?
Yeah, why not?
And the answer, in my view, is like it's much harder to outperform. And
yes.
I don't know why I exist if I'm not aiming to outperform. And so I want each investment to be a big enough part of our portfolio so that if we're investing in top decile funds, top quartile funds, like this should be a great performer. And that's how I think about concentration. But we will have, hopefully, fingers crossed, some that outperform my underwriting and some that underperform our underwriting. That's just likely to happen. So I have to be very careful with returns and with how hard it is to generate DPI, because a lot of this stuff just looks like unrealized gains for a long time. And what actually comes back, if it comes back is like a net DPI, a DPI of like 3x plus, like I think any LP in a venture fund should be happy with that.
When you're in the startup business, you should always be looking for a performance edge. There are simple ways to do this, like getting better sleep. We all know that. But let me tell you about a little hack that elite athletes and U.S. military members use. It's called Ketone-IQ. A bunch of the quantified self people like Andrew Huberman have been talking about the benefits of ketones recently. And Ketone-IQ is a ketone shot that was developed through a contract with DARPA to make American soldiers sharper. You can think of ketones as nature's brain fuel. They have a bunch of proven health benefits like improved focus and weight loss, and Ketone-IQ is a clean energy boost with no sugar and no caffeine. I have been on it for a couple of months now, and my energy level has gone up, 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 and my focus as well. I love taking these shots. I take it in the morning before I work out. I take it when I'm skiing, and man, it makes you feel like a superhero. So here's the call to action. Get 30% off your first subscription to Ketone-IQ at hvmn.com/twist. That's hvmn.com/twist for 30% off. Or you can easily find Ketone-IQ at your local Sprouts Market. It comes in little bottles, and you just take this little shot, boom, you're off to the races. How much of your strategy is based off of watching the portfolios emerge? So let's say you're in 10 funds and they have 30 names in each on average. You got 300 names. There might be some duplication there. So let's cut it back another 20%. So call it 250 names maybe. Is that what you expect to see across those 10 funds or so? 200 names, 250 names?
I actually expect it to be a little higher than that because there are a handful of funds that are lower concentration. Okay. And I also...
so maybe 400 names, 500 names?
Yeah, I think it's more like 400 to 600 funds. And I think we're tracking towards that in the current fund.
So let's say 500 is the number. You're able to determine what the winners are by year 3, 4, 5 of those. And how do you do that? Like, how do you mechanically do that?
Well, I would turn the tables on you. You mean which winners there are of the 500 companies? Which would be the
you can turn. Feel free. You can. I know you had some questions for me.
I mean, it's a great question, and I think part of it is a definition question. So, how do you define a winner? When you're getting really high ownership relative to your fund size, a $500 million outcome could be a winner, even though in many funds that's not a big enough outcome because they don't have enough ownership. Or because they don't have enough, they need bigger wins because of their ownership relative to the fund size.
Let's just say winners in general. These are companies that are breaking out. I'll just use the term breaking out. They're starting to break out because you want to co-invest in some of these companies. So you're reserving some amount of the fund for co-investments, and then you pop up SPVs, special purpose vehicles. So if I was one of your 10 funds and I hit an Uber, but I'm not doing the Series B at $300 or $400 million valuation, you might want to go to your 10 family offices or 20 LPs, whatever number of LPs you have in your fund of funds, and say, hey, we can get an allocation in this, taxi company or, this stock trading app, Robinhood, or we should try to get an allocation in this because we have inside information it's breaking out. How much do you expect of your returns to come from co-investments, based upon those?
I mean, your original question, which was the right question, which was a really interesting question. I love having this conversation. I wanted to ask you that. I wanted to turn the table on you. Like, how long does it take you to know whether you have a winner? And I think I have a decent sense from talking to a lot of fund managers and sort of living through this at QED for how long it takes many people to realize they have a real company, but a company that generates DPI. I mean, that it could be a long time. You may never know until you get it. But what's your experience?
4 to 7 years. They emerge in that number of time. You knew Uber was a winner in year 2 or 3, just based on, I knew it, based on the addiction level that I saw amongst users and the rapid interest from top tier firms in getting intros to that founder to get an allocation. So we saw 2 things there. One was user adoption and just how maniacal users were about the product. When it came to LA, people were like, it'll never work in LA. And then, you talk to 10 executives who use it. They're like, this is a game changer. So, and the press never understood the company. So you just ignore the press and embrace the users. And then when I've got people emailing me saying, hey, can you introduce me to Vlad from Robinhood? Or, hey, my wife, my daughter, my cousin, my son is using Calm and they love it. Can you introduce me to Alex and Michael from Calm? You start getting those kind of inbounds from really top tier investors, or they want to talk to you about it. I just want to talk to you about it. It's like, I know why you want to talk to me about it. You want to place a bet. So, those usually happen in the first couple of years, year 3, 4, 5. And then, the revenue ramp and the quality of the revenue, I think, are the things that determine DPI and the real breakout. So there have been major questions about the quality of the revenue at Uber, quality of the revenue at Robinhood. And so we had to really look at that and say, is this actually a high margin business or not? And then I just did a back of the envelope at some point where I was like, well, they did 100 million rides and they're losing $1 a ride. So, or whatever, they were losing 50 cents a ride. So losing $50 million this month. Whoa, it's crazy. But then I was like, wait a second. The average ride is, whatever, $19. Would anybody not take an Uber if it was 21? And I was like, no. maybe you lose the bottom 5%. If you lost the bottom 5%, you're making $1 a ride. Now this thing's throwing off $500 million a year. That's easy to do. So, I mean, in the press, of course, was going crazy. This could never be profitable. They're burning money. And it's like, you could just flip the switch, though. It's kind of like Amazon's story, right? So I think that's where I come to is you have the user love, you have, inbound interest from other investors or acquirers. At one point I had a very high profile, one of the top 3 technology companies in the world reach out to me to talk about one of the portfolio companies. And they were like, hey, can I talk to you confidentially about this company? And I was like, sure. I talked to them. I was like, oh, they want to buy this company. They want to know, what the founder's like. They, oh, okay, I get it. This is like a Google, Amazon level company having interest in one of your portfolios. That's another signal that this could work out. So I have now I've been working on this a lot because we have a doubling down strategy. And I guess this speaks to concentration of portfolios. And we can talk about that in a second. But what do you think are the early signs of when you have a winner? And how do mine match up to yours?
No, I mean, I think I listen to yours. My job is to sort of listen to the GPs and listen to their experience. So I want to hear from thousands of venture investors about,
what have you heard from other GPs?
Yeah. I mean, well, in terms of time, it's funny. I almost never hear experienced investors say that they know in less than 2 years. Almost never hear that. But I often hear emerging managers say, oh, I'm just going to follow on into my best few companies. We're going to get an enormous percentage of the fund into those best few. And my question is well, how early are you going to get those dollars in? Because often companies are raising their next round. Certainly the market is slower right now in terms of priced A round after a priced seed round. But that's taking longer now than it has in recent
But it
history.
used to be a year later, 6 months later, they're raising the next round.
Right. And so it's in a year.
Changed? Yeah, not much.
Right. Well, maybe you have seen growth. Maybe you have seen a lot of things and you are very high conviction on this company. But you might not have even made all of the initial investments that you're going to make out of that fund. So it's hard to know at that point, at the time a company's raising its next round, which are the best few in your fund. So I certainly see funds where they got the follow-ons all right. And it's amazing. And major kudos to those investors. And some people have done it over many years, over many vintages, and they actually do seem to know earlier than most folks. But most folks, it seems like it's at least 2 years. And so, I'm thinking about that, and I'm looking for signal from the GPs that we've invested with. I'm looking for signal from other investors coming into those companies. I'm typically not in the next round after the initial investment from a fund that we've invested in. Maybe it would be the B round, and we were in the pre-seed, or we have exposure to the pre-seed or seed round, and now we've seen them raise, an A round from a great investor at the A round, and then we've seen maybe someone come in to lead a B, and we're all pretty high conviction at this point.
Yeah. And what percentage of your reserves do you think will be for co-invest like that, or are they all just SPVs and you'll just put them as icing on the cake?
Yeah. So I can, in the current vehicle, we can use up to 20% of the capital of the fund to co-invest.
Perfect. That seems smart.
And we'll be recycling and overcommitting, and so we have room for that even after we're sort of fully allocated is the plan.
Yeah. It's so interesting we're having this conversation right now because I have a large team, because we have massive amounts of inbound. So our deal flow, because of the 2 podcasts, my deal flow was absurd before all in, and then it went absurd again. So it's absurd on top of absurd. Now we have 20,000 people applying for funding. If you're one of those founders, launch.co/apply, launch.co/apply. You can just fill out that form and meet with our team. As long as it's an actual venture style business, not like a pizzeria or a movie or a CD, you're doing your next album. We don't invest in those kind of things. But in training folks, I literally I force myself to write these things down. And I've written down now 2 instances because in our current fund structure, half the fund is going into the primary investments, that first bet through our programs, et cetera, Founding University, et cetera. The second half of the fund is going on to follow-on. So I'm pursuing a Brian Singerman, who I had on the podcast recently. Hey, we're going to put half the fund into the top 5 names, let's say, 10 names, 15 names. We'll see, what the market tells us, right? If we hit a unicorn every 25 and we have 200 names in this fund, well, we've got to divide that second half of the fund by 8. If we have 3 unicorns, we're going to divide it by 3. But we also have to be able to pick them, right? To your point. And so we've come up with likely winners, definitive winners. And so I now have a criteria of what's a likely winner, and I have a criteria of a definitive winner. Now, that doesn't mean it's definitively DPI. It doesn't mean that the money has come in and it's gone public. It just means at that early stage, we can then say, okay, it's a likely winner. We should put in X amount. We should put another 100K in. We should get another 2% ownership. This is a definitive winner. Okay, we want to get more like 3 to 5% of additional ownership and get us past the 10% hurdle of ownership. So yeah, I've really thought about that.
I think, I love it. And one thing I think about is the information that folks should track over time that might be actionable down the road. And so like one thing I encourage people to do who are investing is, hey, like track your level of conviction. Yep. Could this be a fund returner? Not likely to be a fund returner. Like, no, this is a 0. Track that on a quarterly or every 6-month basis, or more often if you'd like, and track like how these companies are trending. Like, are they trending positively? Are they trending neutrally? Are they trending negatively? Like, if you have time and interest, like maybe force rank these, and then like we can talk in 2 or 3 years, and we can say like, hey, how likely is it? Or maybe further down the road, does it ever happen that you get to a point where a company is trending negative and it ends up being a fund returner? Or how often is it the
very
case?
Rare.
That like
very rare, yeah.
Well,
but it does happen.
Like how,
like a save. You're talking about like a crazy save. Yeah.
Right. Or like how long did a company go without, in your mind, having the potential to be a fund returner? And then it actually could still become a fund returner. Like use that information. So now it's like you have this information. You can look back historically and see like, well, historically, nothing has ever emerged from a likely 0x or a likely 3 to 6x return to being a fund return. It's never happened in our history, or it's happened 3 times out of 100. It's very unlikely. If
only I had that from 10 years ago when I was doing this all in my mind. This is why I'm writing deal memos. And so what I do is I capture all of this now. We have 2 investment team meetings a week. I now record them. So I had to tell the team like, hey, never talk, in a spicy way on the investment team call, but we're recording every call. We're transcribing it. We have it. And then we can go search it. So, in 3 years, we can go back to the original decision for making the investment in Uber, Grin, Robinhood or whatever. And we could actually look at that. And then we can look at, we had an opportunity to buy more shares in the company. We didn't have them as a likely winner. We didn't have them as a definitive winner. And that's where like forcing your team to define things, in a very specific way is super powerful. So I can say to the team when they're having this discussion, there's 14 people on a phone call. Okay, is it a likely winner or a definitive winner? And then make your case. You want to put more money into this. Is it a likely winner? Here's the criteria for a likely winner. Or is it a definitive winner? Here's the criteria for that. Make your best case and write it down. And that's why I try to like, we do what's called the mini deal memo. So if people want to fight for an investment, I said, put a mini deal memo in Slack and give us the criteria of why we should invest, why we shouldn't invest. And then I ask other people who maybe have domain expertise or who I think value the opinion. Okay, do you agree or not? What would you do? Some people might say stand pat. Stand pat is one of our internal terms. Like we're not going to add to our position. It's a poker term. It means like check, basically. Stand pat. We're going to stand pat. We're not adding to our position, but we're not selling our position. And let's have a thoughtful discussion about that. And man, has that changed everything in our firm over the last couple of years, that people are using a framework for debate.
Yeah, I mean, I think it's really thoughtful. And it also like dovetails with another thing that's on my mind when I'm thinking about managers. Like, are you thinking about every round that a company raises as like a buy or sell opportunity? And if it's a sell, like, what are you doing about it? Doesn't mean you need to sell. It's not always possible. And if it's buy, it doesn't mean you're in a position to buy. But I think it's helpful to think about it. It sounds like, your analysis is similar to that.
Right now, startups have to do more with less. We all know that. And that means increasing your product velocity while maintaining or even lowering your costs. Now, don't forget, product velocity is how startups beat incumbents. So here's the great news. AI is going to help you do that. So let me tell you about Uizard. It's spelled Uizard. It's an AI-powered suite of UI and UX design tools. With Uizard, you can generate your app or web designs from simple text prompts. You can then iterate on these designs with an AI assistant, and then you hand off your completed designs as React or CSS code. Uizard's text to UI mockup tool is called Auto Designer, and it's really cool. If you're watching, you can see it on the screen right now. here's the brass tacks. Uizard is going to help you go from idea to mock-up in minutes. So if you're creating a product from scratch, this is going to save you so much time. Start building products today faster with 25% off Uizard Pro at uizard.io/twist. That's uizard.io/twist for 25% off. Stop wasting time and start shipping faster. The sell side is super important. Do you talk to fund managers about their strategy for clearing positions and returning capital to LPs? Do you do that when you're selecting them? And then what do you like to hear?
Yeah, I mean, it's really important to me. So like I think about, and we can talk about sort of what I look for when I invest, but at a high level, I think about like venture, like there's like a 5-tool baseball player, there's like a 6-tool venture capitalist. And in my view, like everyone talks about like sourcing, picking, winning. Some people talk about adding value. I would add 2 more to that are really important when like we're making an investment in Slipstream, and that is like getting your portfolio construction right and getting liquidity from these investments. And what I want to hear from folks is that they are thinking about it. They are thinking about it every time a company raises capital, about whether they're buyers or sellers. They are not necessarily acting on it. I want to get a sense for whether they're sort of in the ride or die camp, like, no, we'll never sell early. We're just ride until the end, which I think can be great, but has some drawbacks. There's risks associated with that. And I'd say, like, if there's one regret when it comes to getting liquidity that I hear the most and that I've seen most frequently, it's I waited too long. Like, I regret not taking the it was a unicorn. I could have sold a little into that round. I didn't. Now the company didn't work out, or it went public, but it was locked up. And after the lockup, by the time the lockup ended, I wasn't comfortable.
See, it's very different for seed stage investors versus Series A and Series B investors when you sell, because if you're a Series B investor, you're almost always overpaying. And if you're investing $25 million for 5% at $500 million, okay, like you're not going to sell that position at $1 billion or $2 billion. And very few companies get to $1 billion or $2 billion. So you have to wait till it hits 5, 10x, right? If you've got some basic portfolio construction. If you're invested at $5 million, we invested at Com as an example at $5 million. We had the opportunity to sell 10% of our position at 250. It was like a 40 some odd X, 50X. I took that opportunity to sell 10% of our position. We had an opportunity to sell another 10% of our position. I think we sold $11 million of our position, $12 million in our position when it hit $1 billion change. And I took that opportunity. So we sold 24% of our position going up. That had nothing to do with our belief in the business or the founders. It just had to do with the fact that, 50X, how often do you get a 50X and you have the ability to sell some of it and lock in a 50X and then do it again at, 200X. The great irony of that was that we had some money in SPV. When we told the LPs that we had sold, person was like, "Oh my God, you got me a 50X. This never happened to me in an SPV." And I was like, "Yeah, we still have 90% of our position." They were like, "You have 90%? I don't know what you mean." I'm like, "We only sold 10% of our position." They're like, "Okay, so we sold our position, we own 10%, and so we got a 50X. I was like, "No. We owned 6% of the company. We now own 5.2% of the company. We sold about 10% of our position. We were diluted. You still have 90%. The person could not understand that we had not sold our entire position. "Oh my God, Jake, I love you." Wait, there's more money? We still have 90% of our shares? Yes, we still have 90% of our shares. Now we've been diluted a little bit, but that's par for the course. And I did the same with Uber, and I haven't talked too much publicly about it, but I was able to sell some back to the company, in like 30 some odd dollars a share years before it went public. Now that seems like a stupid trade when the stock's at 70 now, but you got to remember that was 8 years ago. I put that money to work. That money has done more than Uber has in that time. So, there's two sides to this coin. I think Peter Thiel was, very famous saying that he missed the best investment of his life, which was the round I think Yuri Milner did the year before Facebook went public, because in 9 months, people doubled their money. So like 100% IRR on an IRR basis, that was extraordinary. But in terms of like other opportunities Peter Thiel has to put money to work, or Founders Fund does, maybe selling and not having that opportunity, but putting that money into their next fund would have been a better return, right?
Yeah, I mean, look, I think it sounds like you've done a really thoughtful job of getting liquidity, and there are no rules. Like, my conclusion about getting liquidity is like, there are no rules. The rules are, if you ask me, like, if there are rules, they are as follows. Think about every round as a buy or sell. Like hopefully you have enough information to make an informed decision, track your decision, even if you don't take any action in buying or selling, because it will be interesting to see, and we might have learnings from that. And if you have an opportunity to like return your fund or better by taking off 20 or 30% at most, I would hope folks are like seriously thinking about doing that. But it's case by case. And the last thing is, I hope people are just being reasonable about, what a company could be worth at a later exit if they're not going to take it now. Like, I've heard people say, oh, no. Like, this $2 billion company is growing so fast, this could be $100 billion company. And I want to say, like, so few companies are $100 billion. Like, $2 billion is an objectively successful outcome for you. If you're just liquidating the whole thing right now, your fund gets multiples. Like, is it top decile performer? Let's be careful about like talking about $100 billion exits here. I'm not saying this won't happen, but
it's when you bring up the Uber example, there was a famous accelerator. Uber didn't go to an accelerator, but they had invested a little bit, and I think they sold their entire position at $4 billion, which returned a multiple of their fund, like you're saying. And I think Travis had told them, don't sell. And the secret was the angel investors, the people in the $4.5 million round for Uber, myself, Sock, a couple of other people, first round, they didn't have the restrictions on selling their shares. The Series A people and further had restrictions. They couldn't sell. You had to jump through a bunch of hoops. The company had the ability to buy the shares back, all that kind of stuff. And then the $9 billion, I think $8 or $9 billion round was announced within months of that person clearing their entire $4 billion position. So the LPs were like, what? You didn't know? And then Travis told you not to sell, and then we would have gotten 2x in whatever number of months. So I've come to the conclusion that pairing 10% 2 or 3 times for seed funds is the right strategy on the way up. Because if you were an LP, Alex, and I said to you, listen, I know we were in Facebook. I sold 10% at $5 billion. I sold 10% at $10 billion. Yeah, I know the company's worth $50 billion at IPO, but we locked those in, and hopefully you appreciate us locking in those returns and returning the fund with that first 10%, making it a 3x fund with the second, or 2x fund with the second 10%. And hey, we still have 80%. Would you be mad at that? Would you be furious? Or would you think thoughtful person?
No, I would think thoughtful person. And I think DPIs is really hard to get in venture.
Yes.
And getting meaningful DPI, getting multiples of your fund means so much to your LP base. It means so much for your ability to raise future funds, both from them and from others who are looking, especially these days, for fund managers who know how to generate liquidity.
So tell me a little bit about how you pick managers. We've talked before, if you're going into this emerging sector, these are typically unique individuals in the world who want to start their own fund as opposed to go work at one or start companies, be an associate somewhere, be a partner somewhere, and kind of go up through the ranks. So how do you pick emerging fund managers? They tend to be iconoclastic, yeah?
Yeah, so it's a great question. Like, I kind of have like a handful of threshold issues, but then there's a bunch more. So I guess like we'll see how deep you want to go here. But yeah, like my threshold issues are like portfolio construction that can generate fund level returns. So like high enough ownership relative to fund size so that if we get even modest winners, that's a good fund. And if we get some of the big winners that, we've sort of talked about throughout this conversation, that's an amazing fund.
So fund construction.
It's like high ownership relative to fund size.
So high ownership relative to fund size. I have a $10 million first fund. I'm getting 1% ownership. I'm putting 100K checks 100 times into 100 names on average. I get 1% ownership. That gets me down to 50 bips after dilution at the exit. 50 bips, in a 1% of a $10 billion company is 100 million. Half a percentage point is 50 million. My 10x fund with a $10 million becomes a 5x fund. Congratulations.
I even think about like a little higher ownership, but like when the fund is that small, even a little change in ownership actually makes a big difference. So if you're a $10 million fund getting 2% ownership, like that's amazing. That's equivalent to a $100 million fund getting 20% ownership, but you have a much broader opportunity set because if you want to try to get 15 to 20% ownership, those are very competitive. You risk adverse selection. There are only so many opportunities. But if you're writing small checks trying to get 2% of a company, there are a lot more rounds that you'll be able to invest in. And so, if you're getting like 2 to 3% ownership on a $10 million fund, I think that's excellent. If you're getting 1% ownership on a $10 million fund, I think that's solid. I wouldn't be looking for much less than that on a $10 million fund, but like it starts feeling a little ridiculous because, what if they get 0.75% of the next great company? Like, are you going to wish they hadn't done that? Like, no, you're going to wish they did that. And so,
of course,
you kind of you have to have sort of a sense.
This is where accelerators come in. It's one of the reasons I was attracted to putting in so much work to our accelerator and pre-accelerator. We can do 100 or 200 names at $125K for 7%. You get watered down to 3.5%. But, to run an accelerator is the hardest work I've ever done. 14, I think we do 14 weeks with the companies, and man, they squeeze every ounce of value out of our team, as they should. Every introduction, every lunch, every phone call, every strategy session, man, there's two reasons why more people don't do accelerators. One is the amount of work it is. And two, you need to have, if you're just we do 7 people per cohort, you need to have 700 people apply. You can't run an accelerator with 100 applications and accept 7% and expect a good outcome. You got to be accepting 1%, which I think, Gary Tan said they accept 1.5 now or something. We accept like 0.5 to 1.5 depending on the class. Historically.
And you have to get it in very low. You're getting it very low entry valuations. You get great ownership with small checks, and that's great. The second thing I'm looking for is like some competitive advantage unique to the team that is sustainable. So like it's something. It's some reason you think they will win across multiple funds. It's typically like not going to change. Like in QED,
give us an example.
Like QED. And it usually relates to like sourcing, picking, winning.
QED is you're talking about the fintech venture firm.
Yes, that's where I worked prior to starting Slipstream. And I think about, I'll put this in context of QED, but I'll start by giving a little more context. So like, usually this would relate to like sourcing, picking, winning, adding value, ideally all of those things. It could be some domain expertise, like deep domain expertise. It could be operating experience at a successful venture-backed company. It could be some track record of working with founders and showing that you can win competitive rounds with certain types of founders because of certain reasons that they're picking you. And so, or something unique about your picking and your sourcing. But like QED is an example because QED, which was founded in 2008, in 2008, I mean, fintech wasn't really it wasn't a word. It wasn't a category. People thought the category is not like financial services is not big enough to support a sector focused fund. And so there were no fintech investors. There are many today. So just being in fintech is not a sustainable competitive advantage, but no one else had started a company like Capital One. And that was really relevant to fintech founders, or at the time, like founders starting companies in financial services. And if you were one of those founders, how could you not want to talk to the folks who founded Capital One? They're so valuable. And it impacts their ability to source. Of course, all these founders want to meet them. It impacts their ability to pick. They have very unique perspective. They know all the industry players. They know what it takes to build these companies. They know what it sells to, what it takes to sell to customers in financial services. They know operationally what it takes to build a high growth company, to go through an IPO. They're very uniquely
positioned. So it's some amount of pedigree, expertise, and a sustainable one is critical.
Of course, it impacts their winning. It impacts their ability to add value. And the advantage that QED had in Fund 1 is still true today in Fund 8. There is still no one doing fintech, early stage fintech investing who started something like Capital One. Now there have been sort of digital entrants and other folks, but QED is really uniquely positioned, and they will always be, I think.
Fantastic.
So that's an example.
So we got portfolio,
back up,
construction. Sustainable brand advantage of some type.
Sustainable competitive advantage unique to the team.
Got it.
It typically is the reason why they can build a flywheel in a founder community, because founders love them. They all want to work with, this venture fund.
Which speaks to deal flow, right? That speaks to proprietary deal flow is another way. I think that's what you mean by flywheel. Hey, they have that definitive sustainable advantage. Founders recognize it. And that drives the flywheel being more founders apply for funding.
Correct. If QED is great to fintech founders, then the next generation of fintech founders will hear from that. The folks who have worked with QED, hey, QED is amazing. You really should talk to QED. They're the best in fintech. And then QED has this flywheel of making great founders love QED, helping great founders, getting great exits. And then the next crop of fintech founders want to meet QED. And then they keep seeing great deal flow, investing in great deals, generating great returns. And so the last part of that point, though, the competitive advantage that's unique to the team and sustainable, is that you want the strategy built around that, whatever thing makes them so special. It's got to be tailored to them. And so like QED shouldn't go and do deep tech investing. That doesn't make any sense. And like QED should be relatively concentrated. They should be able to work with founders closely. They shouldn't be so low concentration that they don't have time to work with their founders, because their founders really value their involvement after investment. That's a big part of what makes QED special. So they have to have a portfolio construction that allows them to do that. Okay, so that's the second thing. The third thing would be like founders love these folks. I think it is common to say and believe that venture capitalists don't add much value. And I think that's probably true in many cases. But I think the best funds, they often do add value. And at least their founders love working with them, send their best founder friends their way. And that's a really important part of what I'm looking for. The next thing would be like the best investors at the next stage from this venture fund trust this VC, track their deals, and invest in them. It's like nothing feels better to me as an LP than seeing that like the companies that we have exposure to are now being marked up by the best investors at the next stage. And then the last thing would be just like scrappy, entrepreneurial, driven, hungry folks. I think that is often more likely associated with folks on their first few funds, but it's not always. And some folks who more money would not impact their life, and they are as hungry as anyone who's just getting started. And so, but that's an important part of what I'm looking for. And yeah, we can go deeper into any of these things, but like at a high level, like those are my 5 filters.
Yeah. There's the ability to compete for deals that I hear come up a lot. The thing that I don't understand at the seed stage of why people are obsessed with this is when I look at a cap table of a seed stage company, most often there's between 20 and 30 names on it. And so I look at that seed stage funds and I'm like, if you can't be one of the 20 names on the cap table before Series A or 30, what's going on here? Like, they must hate you. Like, they're passing the hat. I literally think it's 98 out of 100 startups pre-Series A, when they do a round, is passing the hat, especially in today's market. Like, you're not fighting for an allocation. Now, you might want a larger allocation in a great company. You want to put in 250 and they are saying you can put in 150, 150K or something. But yeah, generally speaking. So do you think about fighting for an allocation at seed stage, or do you think it's irrelevant or less relevant?
I mean, let's I guess, are we distinguishing pre-seed from seed here? Or
sure, why not? Why don't we do that? Why don't we do pre-seed versus seed? What do you think the difference is between those two? How do you do it? Some people would say pre-product launch, post-product launch. Some people might do valuation. How do you define pre-seed versus seed in 2024?
Yeah, I mean, the way I think about it is in terms of entry valuation, but
okay, give me the entry valuation for pre-seed and seed.
Yeah, what's that?
I have two numbers in mind.
I'm thinking of like pre-seed entry valuations as like sub $10 or $12 million post. And then I'm thinking of like seed stage venture or seed stage entry valuations as more like, 15 to 30 post. And these are like rough numbers. These are changing as the market evolves. What's that?
Yeah. I had 6 and 12.
Yeah.
And the reason I was saying 6 and 12 is because I'm including accelerators in there. So
yeah, that's
accelerators getting at a 1.7 to $2.5 million valuation. And then there could be, $6 to $10 million valuations at pre-seed. And seed, could be 8 to 15. Yeah.
Yeah.
And then Series A obviously is 30. Yeah.
Yeah. And so what's interesting is like, I think there's a lot of activity at seed. There are a lot of funds playing at seed. There are a lot of tier ones who are later stage investors primarily, and others, just like multi-stage investors who are playing at the seed. Now, those companies might be inception stage. They might have revenue and be a little more further in their evolution. Pre-seed is typically pretty early in their evolution. And the entry valuation, is very low. And I think there's less competition there, but the same company might be getting offers from a pre-seed fund and, or like pre-seed valuation offers. And they might also be getting offers at what we have here today defined as seed valuations, right? Like Sequoia might come in and say, hey, we want to value this at 30 post. And someone else may say like, hey, we want to value this at 8 post, right? So like in that sense, these categories, it's hard to distinguish them. But I do think there is a lot of opportunity at pre-seed. I don't think there are that many folks in relative terms investing at the earliest stage, like company inception or before the company is created. We're just bouncing ideas around. Oh, you decided to start that company. I'm going to invest right now. We're sub $10 million entry valuation. That to me is very compelling. That is where I'm more focused there than seed, although we invest in both types of funds. And yeah, I think winning is important in every stage. But I think at seed, it's really important to be able to compete at seed because there are so many players playing at seed. There are so many venture funds playing at seed. And so what I think about is like, what is the reason? Like, do I have a reason to believe, or is there some good reason to believe that this investor or this team will find these companies early, great founders early, and that great founders will pick them? And you have to win unless you're the only investor at the table. And that is so rare. And even if you are the only investor at the table, you still need to win. Like you still need to convince this founder that they should want to work with you. And so it's really important to any investment that we make is understanding like sourcing, picking, winning.
Yeah. My criteria is doubling down. Like, how do you decide on what to double down on? That to me is my obsession right now at the moment because I have deal flow. Right? Like a deal flow, too much deal flow. Decision making, I figured that out. Got a really good system for that. We know what to look for in that early stage, multiple co-founders, builder co-founders, product velocity, consumer love, early adopters really loving the product, 2 to 3x growth rate. We've got a whole criteria there. But really doubling down is the hardest decision I think people have to make. My producers told me you had questions for me. Now, you wanted to turn the tables on me here. Now, usually I don't allow this kind of mashugana, but I'm going to allow it for a couple of questions here. Go ahead. You want to hit me hard with some hard-hitting questions. I don't know what questions you want to ask. I know they put them in the notes. I told them, don't show them to me. I want to give my lightning round here in the last 10 minutes. One thing before we get to the questions you had for me, optimal fund size. Why is this important? Most people in seed, I think they say maybe 50 million or less is the right size, 25 million, 75 million. What's a number if you had to pick the optimal size or the range? And then why is this important?
Yeah, those are such great questions. And so I'll talk about it first in terms of like the factors that I think about, and then I'll sort of like give rough answers that are like more direct. The factors that I think about are like, in the first instance, someone has a venture fund because there's something very unique about them and typically relates to sourcing, picking, winning, adding value. They should be building this around them. And so that's the first question for you. There's no one answer like every pre-seed fund should be $64 million and every seed fund should be like under $108 million. Like I don't have that answer, and I don't think that answer exists because this is such a personal industry, and the success of a venture fund has to do with the people who are sourcing, picking, winning, the founders they are working with, the sectors they're in. Like it's so specific to every person on a venture team and every venture fund and every founder. So I don't have.
But it sounds like 25 to 100 million seems like, or 25 to 75 might be typical.
Yeah,
if we're not saying you have to pick a number, but it's typical.
What gets me most excited from a fund math perspective is pre-seed funds that are 50 million and smaller. Mm-hmm. So like if you're a $50 million fund getting 7 to 10% ownership, sub $10 to $12 million entry valuations, like that's great fund math. You can generate great returns without needing enormous winners. And if you get enormous winners, then you have an amazing fund.
You need only hit a $500 million outcome to $1 billion outcome to return the fund with one investment.
Yeah, I mean, it's all, and then it's relative to dilution, all those things, but yeah, like rough math. And so I'm looking for, like high enough ownership relative to the fund size. On a pre-seed fund, $50 million, getting that level of ownership often gets you like 20, 25 companies at least, could get you a little more depending on how you deal with reserves and how early you're getting into these companies. And I think that's a good number for folks to have. I think I see funds that are more concentrated. It does make me a little nervous. But if people have a history of investing and you can get comfortable with that level of concentration, like I can get comfortable with that level of concentration.
You got a minimum number to hit the power law? You think?
Of companies? It's so interesting. Like,
or as we
I would say less than
logos in the fund.
Like less than 20 logos makes me uncomfortable. But more is more comfortable as long as I believe the team has the capacity to source, pick, and win and work with those companies post investment. I'm typically drawn to funds that are working pretty closely with the companies, and so there's a limit on how many companies they can invest in. But then you see any given fund and you're like, wow, look at that. That's a 20x fund. And you're like, how'd that happen? And you're like, okay, it was actually one big winner and like a couple other solid fund returners. And that got us to 20x. And you're like, man, if they just did 32 instead of 33 investments, would they have missed the big? You never know. It's like this game of just a small number of winners making all the difference. And so I don't think there's a magic number here, but yeah, like less than 20, I'm uncomfortable. More than 40, I'm typically not doing because it's hard to work closely with those companies, although it is possible. And I'm typically drawn to folks who are working closely with companies. So I'd say it's somewhere in the 20 to 40. For me, it's usually more like 20 to 30 companies on a pre-seed fund. And yeah, like ideally around 50 million or smaller, getting 7 to 10% ownership. On a seed fund, yeah, like I'm comfortable with funds that are getting up to like $100 million at this, investing the seed. If they're investing in bigger rounds, hopefully the companies are a little further along and maybe a little less de-risked, although I think the data would not necessarily support that. I think actually it's a great risk reward at pre-seed. Like you don't see a lot of death from like high mortality rates between like pre-seed and seed. And so that is a part of the reason why I am focusing increasingly on pre-seed funds, because of that mortality rate and because like smaller fund size, higher ownership relative to fund size, like
love it.
There are fewer funds playing at that. So there are a lot of seed funds. There are a lot fewer folks investing at what
seed
I'm
funds
thinking
are
of as
generally
like
trying to buy, 10% of the company for $2 or $3 million bucks. Yeah. Something in that
seed
range.
funds leading rounds.
Yeah. Seed funds leading rounds or co-leading.
Like there are folks who say, hey, we're going to be a $30 million fund. We're going to get 4% ownership. In seed rounds, we're going to be investing at 15 to 30 million post or whatever we're calling a seed round. And that strategy can work too. Totally can work. But like if you were to say, hey, Alex, are you interested in a $30 million seed fund targeting 4% ownership or a $50 million pre-seed fund targeting 10% ownership, I would be drawn just from a fund math perspective to the $50 million pre-seed fund.
Yeah. And I think your point is really well taken. The difference between a pre-seed and a seed stage company is typically like very little. And sometimes it's like the charisma of the founder able to raise a bigger fund, going bolder. Some, founders are like, I'm heads down. I only want to raise $250K right now. I don't want to raise $2 or $3 million. I got 2 developer co-founders. I'm a UX designer. We don't need that much money. We don't want to take the dilution. And so that's one of the trends I think is underreported right now is founders being very judicious in how much dilution they allow in their companies. I think this could be one of the big trends of this cycle is founders like not wanting to liquidate, or dilute 30 or 40% in, by their Series A, and they own 50% of the company, and seed investors, pre-seed investors in the Series A own 50%. You're seeing less and less of that. People want to skip rounds. I call them alicorns. Yeah,
I see that too. And I should be careful here because when we're distinguishing between pre-seed and seed, like many funds are just kind of both.
Yeah.
Oh, if we could invest at an $8 million post, like we would. It's not that we're only doing that. Like if we see a great company at a $20 million post and we can get the ownership that we think we need to generate fund level returns, like we're going to take that one too. And so I don't mean to be so rigid in how I think about these funds, because I think the reality on the ground is that many funds are a mix of, I guess, pre-seed and seed. What we're calling pre-seed and seed.
Yeah. All right. You had a couple questions for me. We got to wrap this up here, man. We went long.
Yeah.
Great discussion, by the way. Great guest.
Oh, no, it's been fun. So a few questions for you. One is like, what's the ideal LP for you? Like, how do you pick LPs to the extent that, you're oversubscribed, you're trying to choose, or you meet people and you're like, hey, this person's not a fit, or hey, that person is a fit. Like, what are you looking for?
I like, there seems to be 2 groups of people who enjoy working with us and that we enjoy working with. There are some who are set it and forget it. Hey, we understand venture. We want to place a bet. We understand, you're going to have some funds, fund 1 and 2 might overperform. Fund 3 might underperform. Fund 4 might be average, fund 5 might break out. We understand the dynamics and the randomness of what you do. So we're going to be in it for the long haul. And we want like this level of communication, which is typically yearly audits, and then we have another group, which I really enjoy working with, which is the new retail investors who, hey, I've made some seed investments. It's my first venture fund or my second venture fund. I'm looking to, put $250K to $5 million into venture funds. And, I want to learn. And yeah, I like looking at the Google sheet that you share with your major LPs, over $1 million LPs that have all the, companies in it in real time. And I kind of like the rush. I like the sweat, as we would say in gambling, of like seeing the companies you're investing in and being part of the community, right? So people who really, they seem to fall into those two buckets. The ones we don't like working with are maybe ones who are a little skittish. Maybe they're, overextending themselves. They don't understand the asset category. I've had people in our syndicate who will get really upset at a founder failing, and they'll write like an email, I didn't get updates, and why didn't I get updates? And now you're failing and you didn't work hard enough. And I'm like, hey, reputation wise, like you came into this knowing that 80-90% of seed stage companies go to zero. And you invested in 5 and 3 or 4 of them went to zero. Isn't that what's supposed to happen here? So, let's be gracious and magnanimous in defeat and victory, right? You got to be humble in victory. Hey, people ask me about my investments. I'm like, yeah, I got lucky a couple times. There's a lot of hard work involved. And I also, some of it's luck, and be in the right place at the right time, sliding doors, whatever. And, the more you focus on your process and the better you get at your craft, the more I think you, quote unquote, increase your luck. And so, it's some people are skittish, and I always encourage them to not go into a venture. They should put their money into a mutual fund. They should put them into Vanguard funds, and not be in this asset class. If you want liquidity, if you can't take losses, if you can't take, founders who are, like I said earlier, iconoclastic, effervescent would be like a kind way. Some of them are hard to get along with, and the hard to get along with ones sometimes are the ones who are the most successful. Man, you should not be in this asset class. It's just going to be way too.
That all resonates. And I'm curious, like many GPs I talk to say that they don't know where they stand with their LPs. They don't get much feedback from them.
No, that's been hard for me.
Yeah, I'm curious, like if you could ask your LPs questions, like what would you ask? What do you want to know that you don't know?
Oh, I mean, the one thing is like, just tell me why you're passing on the fund, in all honesty. And I think a lot of LPs are like VCs, we're passing on the majority of what we see in order to, but there's no upside to being honest on why you passed. And so, if you pass because you thought, your fee structure or your carry structure is, I think a little too rich. I would love to hear that piece of feedback. There was a fund of funds who's like, I just can't, do 25% carry or 30% hurdle because I'm charging 10%. That's 35 and 40. It's just way too much. I can't get it past I would love to know that. And I would love for that person to say, I would put 10 million in, I put 5 million in if the fee structure was this. But, Jake, I can't do your fee structure or whatever. And I'm like, okay, fine. Let's have that discussion. Maybe I at least like to know. Right. And so there's no feedback loop. I'm trying to give people permission to tell me candidly. I don't know if they will, but
it's hard to get them to. I mean, it's funny. It's an emphasis of mine, like to be clear. And I really do try to be real with people and tell them like, hey, like, here's what I love. Like, here's why I'm not going to get there. And like, if you're open to it, like, this is a fund that I'd love to see the next fund. Like, I'd love to stay close. I'd love to try to help. And sometimes if I don't think a future fund would be a fail, I don't say that, but it often does result in like staying close to folks because they feel like I was honest. I mean, I was honest.
I had one LP because I insisted that she tell me, and she was like, we just haven't seen somebody have 200 portfolio companies in a fund and then also be concentrated. I'm like, great. Let me explain to you how we're doing it. I explained it all to her and she's like, great. Still a no from us. But I said, I just want to make sure you're not out there, when you're talking to other LPs or whatever, saying, that this is a bad strategy because I am convinced it's a great strategy. Here's why I think you're wrong. I told her why I think she was wrong. You might be right with most folks, but here's why you're wrong in terms of our fund. And here's what I'll show you in the coming years. And she's like, great. If you do show us that, then we would love to be LPs because, just because we haven't seen it before and we have an investment committee that requires us to, hit these notes doesn't mean it's not going to work. And so I just insisted on getting on the phone and just making sure, hey, if you disagree with our portfolio, and listen, I have a unique idea, and my idea is different than what a lot of people have seen. I believe you can put 200 or 300 logos into a fund and then reserve 50% of the dollars for the top 5 names. And the only reason I know I can do that is because my portfolio before had our first fund had 109 names in 4 unicorns. Right. And then we looked at it and I asked myself, did I know Robinhood, Com, Superhuman, and Density would become unicorns? And I knew 3 of them definitively would have been unicorns. With enough time to put the investments in. And if we had, instead of that being a 5x fund, which is where it is on paper right now, it would have been a 15 or 25x fund if we had just made those second bets. And so I'm like, you know what? That was my mistake, not making the second bet on Robinhood, the second bet on Com, Density, and Superhuman. And we had the opportunity to in every single case, but we didn't reserve the dry powder. And that, to this day, makes me insane. Like, this makes me mental to only have that be a 5x fund. Because I knew it could have been 15. Would have been easy to put another 250K into those 4 names. And if you had put an extra 250 or 500K into those names, boom, legendary fund.
Yeah. My last question for you is, VC is a really long duration asset class. Mm-hmm. And I think there are plausible arguments to believe that liquidity could come sooner for vintages now than maybe vintages 10 years ago. And maybe it won't be such a long wait for LPs and funds these days as it was for LPs and
because the secondary market, how vibrant the secondary is.
Companies grow faster for cheaper. They may raise fewer rounds.
Yep.
Secondary
I agree with all
opportunities. Curious what you think. Like, do you think 10 years from now we'll say actually it used to be a much longer duration asset class than it is today?
I think secondary. I think if the GPs choose to build a secondary discipline inside their organizations, you could be right. And I have decided to do that. So after we're going to wrap up our fund May 1st has been the date. And so when we wrap up our fund, my plan has always been to, when we get, to a certain number of investments in Fund 4, to start that process of building the secondary group, deputizing a person. Your job is to look at all of just talk to the secondary markets every day. And there's so many of them now, and just make friends with them, get their phone numbers and say, hey, you know our names, here's the price. When this hits $10 a share, we might be inclined to sell 100,000 shares and take $1 million off the table if you find somebody. And they might say, oh, can we go find somebody for you? I'm like, well, the highest you've gotten is $7 a share. So probably not. But when you consummate at $9, that's when we would probably want to engage. So I was reactive to people calling us because, people would get the cap tables of these companies and start calling the seed investors, pre-seed investors. And so now I want to think about actively doing that, or, and this is a little controversial, just talking to the other funds that do the Series B or C and saying, hey, you did the Series B, the round's closed. We're both on the board of this company. We're looking to pair our investment. If at any point, we don't want to sell our holding, but we want to get our LPs liquidity. If you wanted to buy 20% of our position for 200, we have 1 million shares. You want 200,000 shares. We're kind of at our target now, and we wouldn't mind paring back our ownership and just see what they say. Now that a lot of VCs have not wanted to do that because founders might interpret it as a vote of no confidence. But I think the market's maturing, and there's a way to do it, without having it reflect badly on the company. I'll talk about secondary sales now, way in the rearview mirror, but I wouldn't talk about them in real time, right?
Yeah, I mean, two things that come to mind there. One is, I think increasingly, coming out of what happened in 2020, 2021, and partially 2022, I think the pressures on foot. I think people feel pressure to get liquidity, but I also wonder like whether we're overstating the potential relationship issues with founders when we talk about pre-seed and seed stage investors selling secondaries in growth stage companies. I actually think those issues can be managed, and if the investors are close to the founders.
It's a process. I mean, I've had founders explicitly tell me, like, we want you to waive your pari passu. Like, we want you to not sell in secondary so we as founders can sell more. Now, that's when you've got a real situation where I've had to say to founders, I understand and appreciate that you're asking. I want you to understand and appreciate that we've told our LPs that we would pair 20% of our position. And in a case where I had to do that, actually, I had to do that in one case. They're like, totally understand. I was like,
I also hear of stories. Oh, go ahead.
No, and I said, oh, okay. How did that go with the other investors? Oh, 4 out of 5 other investors said they would waive and they wouldn't sell. You're the only one who's selling. And I'm like,
yeah,
okay.
It's interesting. And I've heard of founders who say, who try to block their early investors from selling on the secondary market because they just think their company's worth more than that investor has agreed to sell it for. And I'm hearing that coming out of the last few years of very high valuations. And that is, I wonder if we'll see more of that in the near future.
If you were an investor in Figma and you could have gotten out at 10 or 15 billion and they had that sell for 20 billion, if you had sold at 15 on the way up, in the Adobe Figma deal, then at 20 billion cracks. And now who knows when you're going to get liquidity at 10 or at half that amount. Yeah, you probably would have felt great about selling at 16 or 14 or 15, some percentage of your ownership, right?
Right.
So,
I mean, the hope is that founders let investors do this, but we'll see.
Yeah.
It'll be case by case.
All right, Alex. Well, since you're interviewing me, you get to sign off.
All right. Thanks to everyone for tuning into This Week in Startups.
I'll see you next time.